Hi and welcome to Swissquote's Daily Market Talk. It's Monday, January 13th. The US announced another set of strong jobs data last Friday, sending the US yields and the US dollar higher across the board. Equities suffered losses while crude oil rallied on further US and British sanctions against Russian oil companies. Now, this week, investors' attention will be shifting to the US inflation data and the earnings. So yes, I guess everybody saw the US jobs report last Friday that came in surprisingly strong yet again. So in numbers, the US economy added more than 250,000 new non-farm jobs in December. That's some 90,000 more than expected by analysts. And unemployment rate fell to 4.1%. Now, one encouraging piece of news for the Fed, though, was the softening in the wages growth from 4 to 3.9% on a yearly basis. But all in all, the report looked very strong. So that's excellent news for the US economy. And that's also excellent news for Joe Biden, who will be passing on an unabatable US economy to his successor, Donald Trump. But that's not necessarily good news for the equity markets and the financial markets generally, as the strength of the US jobs data further dashed the dovish Fed expectations. Last Friday, the US two-year yield that captures the Federal Reserve's rate expectations jumped to 4.40% level. So that's the highest level since November last year. The US 10-year yield spiked to 4.78% mark, the highest since October. And the 30-year yield hit the 5% psychological mark. And the probability of a no rate cut from the Fed in May spiked to 67% in the aftermath of the data release. And the probability of a June rate cut from the Fed is, well, now close to a coin flip. Of course, the melting Fed cut expectations hammered risk appetite on Friday and sent the S&P 500 more than 1.5% lower on Friday's trading session. The index closed a touch above its 100-day moving average. The Nasdaq 100 gap opened below its 50-day moving average and lost a similar amount than the S&P 500, while the Dow Jones slipped 1.63% and the small caps tanked more than 2% on Friday on rising US yields and on prospects of higher Federal Reserve rates for longer than imagined. So the latter, the melting dovish Fed expectations, put the optimistic outlook for the stock markets at jeopardy. Especially the fact that the US yield curve has been steepening, meaning that the long-term yields are rising faster than the short-term yields, is not good news for these stock valuations, mind you, as stocks tend to face larger setbacks when long-term yields climb more rapidly than the short-term ones, reflecting inflationary pressures and also reflecting tightening financial conditions. So sentiment in the market is fragile walking into the new trading week, with the VIX index that gives an idea to investors on investors' stress levels is gently mounting toward the 20 psychological mark. And remember, the rising volatility in the market is one important characteristic of bearish market conditions. So it is in this mindset that we are kicking off the new week of trading and the earnings season in the US. So the US will be releasing its latest inflation updates tomorrow and on Wednesday this week. Tomorrow, the producer price index from the US will give us an idea on the evolution of the prices paid by producers in the US in December, and is expected to show a slowdown from 3.4% to 3.2% last month. However, on Wednesday, the US CPI update is expected to print an uptick in US headline inflation from 2.7 to 2.9%, while core inflation in the US is seen super sticky above the 3% mark. So a sufficiently strong set of inflation data from the US this week could even throw the expectation of a June rate cut from the Fed under the bus. So if that's the case, stock investors could only rely on earnings to keep their heads above water and slow a potential sell-off on that front. On the earnings front, the US big banks will be opening the dance this week with JP Morgan, Wells Fargo, Goldman Sachs, and Citigroup expected to announce their quarterly earnings on Wednesday this week. Bank of America and Morgan Stanley are expected to release their own earnings on Thursday this week. And note that TSM will also be announcing its own fourth quarter earnings on Thursday. And the expectations there remain quite high because Nvidia's partner in crime, TSM, announced that its fourth quarter sales rose 39% to around $26.3 billion last quarter and topped estimates as a clear indication that the AI spending will be extending into this new year. So TSM shares could eke out a 0.60% gain on Friday in the middle of a broad-based market turmoil, while Nvidia shares couldn't really enjoy the good news from TSM because the company's share tanked 3% on Friday's trading session. But back to my banks story. Well, the financial stocks of the S&P 500 jumped up to 40% last year and are now around 28% up compared to the beginning of last year. So the high interest rates and especially the steepening yield curve in the US offer the US big banks the possibility to pocket interesting net interest revenues. Plus the trading activity was stronger last year and deal making also picked up. As such, while the financials could print a 40% increase in their earnings growth last quarter, also thanks to the easy comparisons to the year before, mind you, because the regional US banks, which actually had suffered the year before, remember that big time, are expected to report earnings of around $3.1 billion compared to a year ago loss of $3.8 billion. And also keep in mind that the upcoming Donald Trump administration's plans of deregulation for the financial sector are also expected to make the bank investors feel better in the coming quarters. So the outlook for banks in the US remains positive. And zooming out of the banks, the S&P 500 companies are expected to print an 11.7% earnings growth in the fourth quarter of 2024. But FactSet highlights that the index will likely report a year-over-year growth in earnings above 14% for the fourth quarter of last year, based on the average improvement in the earnings growth rate, they say, during the earnings season. So if that's the case, if we end up seeing a better than expected earnings season in the US, well, that could eventually throw a floor under a potential sell-off that we might see in the US stock markets due to the hawkish Fed expectations. But the deteriorating Fed expectations still remain the major risk to the positive outlook in the US equity markets. Elsewhere, the US dollar kicks off the new week on a positive note on the back of the hawkish Fed expectations, and the euro dollar is testing the 102 support this morning at the time I'm talking here, with growing chance of pulling out this support on the back of a broadly stronger US dollar across the board due to this rising hawkish Fed expectations, as I said before. In the energy space, US crude advances with big steps these days. The barrel of US crude actually trades above the $78 per barrel level this morning, and that for the very first time since October, as the US and the UK together announced important sanctions against two major Russian oil companies that actually exported just below 1 million barrels per day in the first 10 months of 2024. That's around 30% of Russia's total flows on tankers, according to Bloomberg. So the US also sanctioned more than 180 vessels associated with Russia's shadow fleet to move this oil, doubling the number of targeted oil tankers. So the latest actions are expected to counter that 1 million barrel per day oil surplus forecasted by the IEA this year, and it's positive for oil prices. But the price of crude rose too fast in a too short period of time lately, sending the RSI index into the overbought territory. So that could limit the upside potential in the short run, yet the short-term outlook still looks positive, and the US crude could be able to test the $80 per barrel level in the extension of the current rally. So price pullbacks could be interesting opportunities to strengthen the tactical long positions in oil. But I still expect strong resistance near that $80 per barrel psychological level, and that on the back of little supportive global economic and China outlook. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.